Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, before we start talking about our portfolio, which has been a very tough week and a tough couple of months, really. We start off with the S&P 500 because this is, I suppose, the engine for a lot of stock markets. And at the moment, it's hard to get a clear sense of where it's headed.
Yeah, that's why we look at this first every week, because it does kind of set the stage or set the scene for the rest of the equity markets around the world. And what the US does, you will tend to find the rest of the world does sort of follow to a certain extent. So that's why we look at it every week. It's been rather confusing over the last little while for us. Obviously, a few weeks back, I'd been talking about this large head and shoulders pattern, which did play out. It broke down below 2,800, which was the neckline of that pattern. But then it actually didn't stay down there for very long, and it didn't meet the downside target. It actually then rallied, and it's now rallied back above the neckline of that pattern and back above the right shoulder. And in fact, now it's back above the 50-day moving average and appears to be holding above there. If you look over the last week or so, the 50-day moving average comes in at around about 28.75. And that area has been holding as support over the last week. So it does kind of give me the sense that whilst it's holding above the 50-day moving average, one probably needs to give a slight benefit of the doubt to the upside from here. But I don't know for sure. You can see there's a little pennant pattern there. It's sort of like a small triangle pattern. If you zoomed in on an hourly chart or an intraday chart, you would see that more clearly. But typically that is some sort of a continuation pattern, and invariably one would expect it to break in the direction of the trend that from which it entered the pattern, which in this case would probably lend itself slightly to an upside breakout. The key this week is going to be the Fed. They've got their interest rate decision tomorrow evening, Wednesday evening, and by all accounts, all expectations are that there will be no rate cut at this Fed meeting, but quite likely that they will set the stage for a possible rate cut at the July meeting. And this is far cry from what we were talking about just a couple of months ago. I mean, at the end of last year, we were talking about the possibility of 4 rate hikes during 2019. Even as much as sort of 6 weeks ago, we were still talking about the possibility of maybe one more hike in this rate hiking cycle. And now all of a sudden, the economic data has begun to soften, and now you've got a very high probability, it seems, that we will see 2 cuts on the Fed funds rate between now and the end of the year. So a very, very different backdrop to how we were just a couple of months ago. And just to that point, I mean, I showed this slide last week, but I just want to revisit it again now. And that is to show how the market, or particularly how the S&P 500 has responded to the first Fed rate cut in each of the rate cutting cycles. And it goes back over many decades, but the most recent 2 rate cutting cycles began in January 2001 and then in September 2007 after that. And you can see within a month after that, on those 2 occasions, the S&P 500 was quite nicely higher after the first rate cut, but then the market fell away after that. And just again, to that point, I think it's important, since this is such a topical point at the moment, US interest rates and Fed funds rate, have a look at this chart. This is a long-term chart, and what it does is it overlays the Fed funds rate, which is that red or orange line, over the S&P 500, which is the blue line. And it goes all the way back to the beginning of this millennium, effectively, back to the year 2000. So you can see what's really critical, and why I want to stress this here, is that typically you'll find that rate cutting cycles are associated with weak economic environments.
Yeah, I mean, there's a reason for cutting rates.
Exactly, and consequently weak stock markets. So if you have a look there, during that rate cutting cycle from 2001 onwards, notice how the Fed funds rate was cut aggressively, but also look at what happened to the S&P 500 at the same time. That was a major, major bear market. And again, after the financial crisis in 2008, notice a very, very aggressive rate cutting cycle by the Fed, and notice what happened to the S&P 500. It also went down. So, ordinary economic thinking would say to you, well, lowering interest rates must be stimulative for the economy, must be good for stock markets. In reality, it's actually the other way around. They only cut rates when the economic data is really weak, and therefore it's an environment where equities are underperforming and are often weak.
Although having said that, then the subsequent years from 2010 to 2016, when there was no change in Fed rates and they were at rock bottom levels, you saw an equity rally. So
You did. So we've had very, very low interest rates for a number of years, and you can see the equity market rallied there. But also keep in mind, during that time, we've also had quantitative easing. So the Fed has been effectively injecting liquidity into financial markets and into the economy, which has pumped up this, what some are saying is a bubble. And now we've had a bit of a rate hiking cycle over the last 2 years or so. But now we're getting to what is, it looks like the end of that rate hiking cycle and the start of a rate cutting cycle.
Yeah.
So, and the thing is, this time around, if you look at where the Fed funds rate is now at 2.5%, it's much, much lower than what it was back in 2007 and even before that in the prior cycle in 2000. So what it really means is that the Fed doesn't have a lot of ammunition to fight off a pending recession in terms of interest rates. And if they cut interest rates all the way back to zero, that many economists are saying is simply not going to be enough to actually fend off a possible recession.
Yeah.
In which case then we might introduce more quantitative easing, and it becomes a much longer discussion than what we have time for.
Yeah.
But the point I really want to make is that, and I think to summarize this part of the show, is that I think in the very short term, if they do start to talk rate cuts, I think that could be short-term bullish for the S&P 500, but on a medium to longer-term basis, it's actually quite a big concern.
Yeah. This partly ties into, okay, before we talk about the recent trades, our top 40 spot, I mean, today is a very strong day for the markets. You know, we've had some of the domestic shares doing really well. The rand's strengthened a little bit. Also, where are we at the moment?
Yeah, so we've had a very strong rally throughout the latter part of May and into the middle of June now. You can see the markets now pushing up against the underside of what was previously this upward trend from December last year. And it seems as if we are in a little bit of consolidation mode here. You're right that the domestic area of the market is fairly firm today, the banks and the retailers. But and that's on the back of a firmer rand. But then, of course, with the firmer rand, you've also got the currency sensitives underperforming. So your resources and your golds and the Nasdaqs of the world and whatever, your Richmonds are underperforming the market because of a firmer rand.
Okay, Garth. Now let's talk about last week's trade, which was a short position in Gold Fields, and it was counter where the market had been heading, but you'd seen these exhaustion gaps, which you thought might herald a bit of a pullback. Didn't happen, did it?
Well, it hasn't happened yet.
Yes.
And so what we did, I mean, you can see there's the chart. It had this massive move up through the latter part of May and into early June. Gold Fields was up 50% during those, what was really 2 weeks. It was a massive move to the upside. It was on the back of a firmer gold price and a weaker rand, right? But you can see those exhaustion gaps that I spoke about last week, and those are very often the signs that, as the name suggests, it's exhaustion. It implies that the move is basically exhausting itself. It's almost at the end of a move before you get some consolidation and a pullback. And based on that, I had my reasons last week as to why we decided to go short of 800 CFDs in Gold Fields at 74 Rand. And I said I would use a stop loss above the recent prior high, which was at 77. And I was looking for a move down to this lower gap here at 68 to bank a profit. Now, unfortunately, as you said, we have been stopped out. The price did shoot higher in the latter part of last week. I don't use automatic stop losses all the time, and in this case I didn't. So I was stopped out at 78 Rand, whereas our stop loss was at 77. So a little bit of slippage on the trade there. And that means, unfortunately, we lost 3,400 Rand on this trade. It is down today. I mean, when I last checked, it was down at about 75 Rand. And I must say, if I look at this, instinctively, I still do feel like the stock is probably in a short-term topping pattern at the moment. And I would still feel it's quite a strong possibility that it's going to go down and target those lower gaps in the next couple of weeks. But, rules are rules. One of the things on this show that we've always done well with is the discipline and sticking to stop losses and making sure that our losses are contained. When you've got something wrong, you've got to admit it and walk away.
Yeah. It's
been one of the key pillars of our success on this show over the last decade. So the fact is we were stopped out. We're out of the trade. It's a pity we lost a bit of money. And I can think what I like. The reality is
the market is doing what it's doing.
The market's doing what it's doing. But we'll see. Perhaps in a few weeks' time, it will go down and fill those gaps. I still suspect that might actually happen. Yeah. But like I say, the market doesn't care what I think. The market's going to do what the market's going to do. And I have to adapt my behavior to fit the market and not the other way around.
It is frustrating though, because it's been a really, it's not been a great year, and we'll show that towards the end, well, at the end of the show with the state of the portfolios.
No, it hasn't. You know, we're now sitting at the half-year stage, and our South African portfolio is only up 4% and a bit, and the offshore portfolio is down 2%. So it's really been a difficult year, and it's been very much a year of one step forward, one step backwards, which is frustrating. If you look at last year's performance, we did really well, but when you really sort of look and dig deeper, we only really made a lot of money on 3 or 4 trades in the year. And there was a lot of one step forward, one step back during that year as well. So, yeah, I guess we just need a break where we can maybe take 3 or 4 steps forward instead of one step forward, one step back, one step forward, one step back.
Yeah, well, we'll detail those portfolios. But to end off with, we've got 2 stocks that you're going to watch this week, not trades, but Amazon and Philip Morris, the tobacco company.
Yeah, so one bullish, one bearish. So this is Amazon.com. This is the bullish one that we're looking at here. You'll see that there's some sort of a similarity in a way to what I showed about the S&P 500, where there's this little pennant pattern forming, and the stock looks as if it might be breaking to the upside. It is also holding above the 50-day moving average. So if there is to be a bit of a move higher in the US market, broadly speaking, I think Amazon can probably go higher and maybe even try and make an effort to go and retest that May high at 1950. And then Philip Morris is obviously a cigarette manufacturing business. Very, very challenged industry at the moment in terms of regulations, and it's not an easy business to be in, I don't think. Lots and lots of headwinds. Now, from a technical perspective, that to me looks like a descending triangle pattern that is forming over there. The lower end is at about $77 per share, and typically you would expect a pattern like that to actually break out to the downside. So if it does start breaking down below 77, then what it would probably mean is that it's going to go back and target that January low, which was down there at about $70 per share. And it's been underperforming the S&P 500 quite markedly over the last couple of weeks. So for this one, I think the bias probably is to the downside.
Yeah, okay, so 2 shares to monitor, and also it might introduce a bit more activity on the offshore portfolio. Yeah. So let's look at the I don't want to call it a horror show, because it's not exactly a horror show, but it's not great. And it's, I mean, in the 10 years actually that we've been doing the show, would you say this is probably one of the worst half-year performances yet? It
is, without a doubt. This has been the hardest half-year period that I've encountered over the 10 years that we've been doing Traders Corner. So yeah, there it is. I mean, we're up 4% for the year to date on the local portfolio, which is very poor comparative to prior years. But as you say, it's not a horror show. It's just a bit boring, really. It would be nice to be up some more than this, but I mean, at least we're not losing money, I suppose. There's, thank goodness for small mercies, right? And then the offshore portfolio, like you said, we haven't been very active. We're down 2% on that, and we'll keep an eye on the Amazon and the Philip Morris possibility for this week.
Yeah, and then just a reminder, Garth, viewers can get a weekly alert to see what's coming up.
Yes, if you go to traderscorner.co.za and you look in the middle of the page, you'll see a link for a free weekly email. If you click on that, enter your details, it won't take too long. And then what we'll do is send you an email every Tuesday detailing exactly what is coming up on this show for the week ahead.
Yeah, Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.